Companies have been blowing their cash reserves. Meta's reserves have declined from $64 billion to $37 billion, a decrease of 42%. Google's reserves have declined from $142 billion down to $115 billion, a decrease of 19%. Microsoft's reserves have declined from $136 billion down to $104 billion, a decrease of 23%. And Apple's reserves have declined from $107 billion down to $51 billion, a decrease of 52%. This isn't some sort of a random fluctuation either. For the past decade, all of these companies have been vigorously increasing their cash reserves up until the past 12 to 24 months. With such massive decreases in cash reserves, you would think that these companies have been furiously paying off their debt, but that's not the case either. Apple, for example, has maintained their long-term debt at right around $100 billion. Google and Meta, on the other hand, have even gone as far as increasing their debt. Google has increased their long-term debt by over 200% from $4 billion to $14 billion. Meta, on the other hand, is holding debt for virtually the first time in the company's history. This makes no sense at all. These companies were hoarding cash in the tens of billions, if not hundreds of billions, when interest rates were low. So, with high interest rates, you would think that they would just double down on their cash reserves and pay off their debt as quickly as possible, but they've actually been doing the exact opposite. So, here's why companies are blowing their cash reserves and where all this money is going instead. Starting off with the most obvious reason, we have high inflation. During times of high inflation, idling cash is rapidly losing its value, so it makes sense to decrease your cash reserves. But it's not actually that simple. If you look closer at these companies' balance sheets, you'll see that many of them were starting to slash their cash reserves well before inflation got out of hand. Inflation didn't even cross 3% until the second quarter of 2021. But by this point, Apple had already decreased their cash reserves from $107 billion down to $61 billion. This trend is even more evident at Microsoft, who has refused to increase their cash reserves since 2016 at this point. During this same time period, their net income has rocketed from $25 billion per year to $70 billion per year. So the choice to cap off their cash reserves is very much an active one, but why? Well, a lot of it can be explained by Dr. Michael Jensen's research paper that was published way back in 1986. The paper basically argues that holding cash is a terrible sin for corporations, and Jensen supports this idea with 5 reasons. We'll take a look at the 3 most notable reasons. The first reason is that there is an inverse correlation between cash reserves and organizational efficiency. This makes sense, and you can probably relate to this yourself. When times are good, you're more likely to eat out more often, buy a phone you don't need, or keep subscriptions that you don't even use. The same idea applies to companies. The more cash they have, the more likely it is that they overhire employees, fund low ROI projects, and pay bloated salaries. Wait a minute, isn't that the metaverse? Anyway, Jensen actually takes this idea to the next level. He not only argues that higher cash reserves lead to lower efficiency, but higher debt levels increase efficiency. In other words, modest cash reserves and debt are optimal for maintaining corporate efficiency. Moving on to reason number 2, this is more of an observation than an argument. Jensen observed that leverage-increasing transactions correlate with significant positive increases in stock price, while leverage-decreasing transactions correlate with significant decreases in stock price. The obvious reasoning for this would be that companies taking on debt are likely funding some sort of expansionary effort, while companies that are reducing debt are likely taking risk off the table. Moving on to number 3, this is likely Jensen's most contentious argument. He basically argues that larger cash reserves lead to more diversification, which is apparently bad. The idea is that companies are far more likely to succeed when they invest in areas that they're already dominant in, as opposed to a new area. As cash reserves grow, however, the temptation to diversify into new businesses becomes larger, which often leads to more losses than profits. These conjectures have simply been strengthened over the years with newer research. One study, for example, analyzed corporate earnings growth between 1871 and 2001. The study found that earnings grew the fastest when corporate dividend payout ratios were the highest. In other words, when companies were paying out most of their profits, conversely, stock performance was poor when companies hoarded cash. None of this is to say that cash reserves themselves are leading to poor performance, but rather that bloated cash reserves are generally a sign of a fundamental shift at a company, a shift that's usually not for the best. Alright, so you don't want to be holding on to too much cash as a corporation, but then where do you put all this money? It's hard enough to safely invest a few $100,000, so how in the world do you invest a few $100 billion? Well, the answer usually breaks down into three main categories, starting with short-term securities. This primarily consists of government bills that mature within the next 12 months. One-year government bills are currently yielding 4.7%, so it's a pretty solid bet for corporations. Not only are bills producing great returns, but they're also considered risk-free as they're backed by the US government. In fact, they're so safe that bills are generally just counted as cash. Remember how we talked about Apple having $50 billion in cash reserves? Well, only $20 billion of that is actually cash. The other $30 billion is marketable securities or government bills. If we look even closer, we'll see that even the cash portion is not fully cash. The official title for this entry is cash and cash equivalents. This basically means super short-term government bills that are maturing within the next month and/or money market funds. So that's where companies store the money that they need within the next 12 months or so. As for longer-term reserves, companies primarily turn to government bonds once again, but this time the maturity is far longer, something like 10 to 15 years. 10-year government bonds, or technically notes, are currently yielding 3.3%, which is much less than one-year bills. But the benefit is obviously that you get to lock in this rate for a full 10 years. This is usually where companies store the bulk of their cash. Apple currently has a whopping $114 billion in long-term marketable securities. So basically, all the cash goes to government bonds of varying durations. But what if a company still has too much money left? Well, that's where the infamous stock buybacks come into play. Buying back stock allows for companies to artificially inflate the value of their stock due to simple supply and demand. By purchasing stock, Apple is able to reduce the amount of Apple stock that's available on the market. At the same time, they're also increasing the demand for Apple stock because, well, they're buying hundreds of billions worth. In fact, over the past decade, Apple has bought back, wait for it, $573 billion worth of stock. For perspective, that's enough money to buy out the 9th largest company in the world, cash. Apple is not alone in this trend either. Google has spent $150 billion within the past 5 years. Facebook has spent $100 billion within the past 5 years. Microsoft has spent $170 billion within the past 10 years. And corporations as a whole have spent $5.3 trillion on stock buybacks within the past 10 years. So investing cash into government securities and stock buybacks has very much been the go-to strategy for corporations historically. But this has started to change in recent times. As you can see, large cash reserves are usually a dark sign for corporations. So they try to make sure that cash reserves don't get too out of hand by investing in government securities and stock buybacks. But that's the old school method. The new school method is to trade cash for something much more valuable. The reality is that the value of cash is declining, and I don't mean because of inflation. I mean that the fundamental value of cash as a currency itself is declining. This isn't a new trend by any means either. Cash has been a suboptimal currency for over 100 years at this point, basically since the Fed was created way back in 1913. Since then, it's been ingrained in our minds that currencies lose value over time, because that's all we've ever seen with cash. But this is not true. Good currencies increase in value, and for a very long time, cash was actually a great currency. In fact, between 1800 and 1900, the value of cash actually increased. $1 in 1800 was only worth 67 cents in 1900. Think about that. Money in 1900 was worth more than it was 100 years before that. Of course, this changed with the Fed, but that's not to say that all currencies became inflationary. The new currency to hold was gold, at least until FDR banned it in 1933. Following the ban, the new currency to hold was oil. All of the richest people in the world between the 1930s and 1970s were those who controlled oil. With the 1980s and Reaganomics, however, the optimal currency switched to being stock, and that's how it's been since then. Billionaires like Jeff Bezos, Elon Musk, and Bill Gates aren't holding oil, gold, or cash. They're holding stock, but this is once again changing. The new currency is attention, and the biggest companies in the world know this more than anyone. This is why they're more than happy to pay ridiculous sums of money to buy attention. Likely the best example of this is WhatsApp. When they were acquired, they were completely worthless from a traditional business perspective. Despite having 450 million users, the app was only bringing in $10.2 million in revenue and was losing $138 million. Another way to look at this is that each user was bringing in a glorious 2.3 cents per year and losing the company 30 cents. Obviously, a terrible situation from a financial perspective. Facebook could have easily gone out and replicated the app for no more than $10 million, and even that's being generous. But what Facebook could not replicate was the interest that WhatsApp had, and that's why they paid a ludicrous $19 billion for the company, or $42 per user. This is the same reason that Microsoft bought Skype for $8.5 billion, why Apple bought Beats for $3 billion, why Microsoft bought GitHub for $7.5 billion, why Microsoft bought LinkedIn for $26 billion, why Salesforce bought Slack for $27 billion, and why Elon bought Twitter for $44 billion. None of these companies created something truly revolutionary. More times than not, their products could be replicated for a few $100,000 or a few $1 million max. But what's nearly impossible to replicate is their user base. And that's why tech giants are blowing all their cash acquiring these startups. Essentially, they're trading their cash and/or stock for attention, as that's the far more valuable currency. For most people, being financially rich is defined by having a bunch of cash, but for most companies, this is a nightmare. Growing cash reserves indicate that you're running out of places to invest and grow the company, which is a big no-no for investors. Traditionally, companies would trade their cash for bonds and stock, as these were the superior currencies, and these are still very popular options today. But more and more, we're starting to see companies trade cash for attention. They're not looking for cash flow or solid business fundamentals or a unique business or any of that. What they're looking for is how to maximize the attention that they can get for their cash, as this is the real currency of the 21st century. Currently, there's still a bunch of companies in the Fortune 500 that aren't doing this. But give it 20, 30, 40 years, and the only way to be in the Fortune 500 will be to control attention. And that's why the smartest companies are blowing their cash reserves in return for attention. Would you rather have cash or attention? Comment that down below. Also, drop a like if you'd like to see more economical analyses just like this one. And of course, consider checking out our Discord community to suggest future video ideas and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.